Agency versus bridge. Those are going to be your two most common lending products when you're looking at multifamily properties. Now, that's going to be the topic of today's video. I'm going to get into what each one of them is, where to get each one of them, the pros and cons of each, and when you should use one versus the other. All right, let's get to it. First, agency loans. So, what are agency loans? So, these are going to be fixed rate loans provided by GSEs, government sponsored entities. I'm going to get into what GSEs are in a second, but basically, agency loans are going to be the standard for permanent financing. And by permanent financing, I mean financing with 5+ years on the long term. And they tend to have higher prepayment penalties. So, as I mentioned, these loans are provided by GSEs, the government sponsored entities, which are the agencies, which is why they call them agency loans. Now, these agencies, they buy mortgages from lenders to add liquidity to the market. Now, you likely heard of these agencies before. There's Fannie Mae, the Federal National Mortgage Association, and Freddie Mac, the Federal Home Mortgage Corporation. Fannie Mae tends to focus on larger commercial banks and credit unions, and Freddie Mac tends to focus on smaller commercial banks and credit unions. So these organizations either hold mortgages within their own portfolio or they repackage them into mortgage-backed securities. Now, neither one of them actually underwrites loans directly. You can work with approved lenders within their network. For Fannie Mae is going to be DUS lenders, and DUS stands for Delegated Underwriting and Servicing. And then for Freddie Mac is going to be Optigo Seller Servicers. Now, it's worth mentioning the third entity, which you may have heard of, which is Ginnie Mae, which stands for the Government National Mortgage Association. So, unlike the other two, Ginnie Mae is not a government sponsored entity. It's actually owned by the government. Fannie Mae and Freddie Mac are not owned by the government. They're privately owned, but essentially ran by the government through a conservatorship. Now, Ginnie Mae does not buy loans, but it does guarantee loans that are provided by the FHA and VA, government organizations. All right, now when should you go and use an agency loan? So an agency loan should be used when you're getting a stabilized multifamily property with 90% occupancy or better. And it's also for multifamily exclusively. You can do some mixed use, but it has to be predominantly multifamily. I want to say maybe 75, 80% of the uses need to be multifamily. So what are the pros of getting an agency loan? For one, the loans are non-recourse. Two, they have relatively low rates. And three, part of your term is going to be interest only, which can help with cash flow. All right, so what are the cons of agency debt? Well, for one, you have limited asset types. So again, it's going to be primarily for multifamily, and there's not much room you have to wiggle around that. Two, they have stricter property qualifications. So as I mentioned, that 90% occupancy and higher is going to eliminate a lot of value add deals. Three, they tend to have higher prepayment penalties, which are going to make it difficult if you want to exit quicker and try to take advantage of a good offer. Now, bridge loans. So, what are they? So, these are going to be short term loans, typically 1 to 3 year terms that are meant to bridge stabilization, allowing for renovation and lease up of an asset. Now, these are typically going to be full term interest only or IO, which means for the entirety of the loan term, you're going to pay only the interest on the property. And also, these are going to typically be floating rate, which are going to be tied to some kind of index like SOFR, the Secured Overnight Financing Rate, which means your loan mortgage is going to be adjustable. It's going to shift with the market or whatever SOFR is. But you also have the opportunity to be able to get some fixed rate bridge loans, depending on the lender you go to. Now, these loans are typically going to be provided by banks or private lenders, but in some cases, agencies can provide bridge loans as well. So when should you use a bridge loan? Now, these loans are typically going to be used in a value add project that may not qualify for agency debt because it's not stabilized or doesn't meet the occupancy requirement. It also can be used for other asset types, not just multifamily. So in the case of a value add project, say you're going to acquire a 200 unit property that is not stabilized, it might be, call it 80% occupied. So it might not meet that 90% requirement for agency, but you think it's a good deal. You think you can go in, acquire the property, renovate the units, and then lease up the vacant units to be able to improve the value. And you think you can do this within, call it a 24-month time frame. So in this situation, you will use a bridge loan to acquire the property. You don't have that occupancy requirement, and then in that 1 to 3 year, call it a 3 year term, You plan to renovate the units and then get occupancy up to about 93 to 95%. So you do that within the 2 years, and then you have a year left to be able to refinance into permanent financing. So as I mentioned earlier, permanent financing is going to be 5 years or more. So you might use a bridge loan for the first 2 to 3 years, and then once you have the property stabilized, you then refinance into a longer term agency loan, and now you have a higher value property. So the pros of bridge debt is going to be flexibility across asset type and the actual property. You have quick closings. You have full term IO, so not just a period of the term, but the entire term is going to be IO. And then you tend to not have prepayment penalties. And that's because bridge debt is meant to, just bridge a gap. So they expect you to get out early once you're able to stabilize the property. So they don't typically charge a prepayment penalty. Now, the cons of using a bridge loan is going to be higher interest rates because there's more risk associated with a value add project as opposed to something being stabilized. Is going to be higher risk and they're going to charge you a higher interest rate for it. You also have the risk of not being able to execute the business plan within the term. So, say in that 200 unit example, if you try to get everything stabilized within 2 years, but it takes longer than expected, and then by the end of year three, you haven't stabilized the property, now your loan term is ending, but you haven't stabilized to be able to refinance. There's a risk associated with doing that. Then, three, you have the floating rate interest risk. So because you have a floating rate debt, your rate is going to be adjustable. So your mortgage can go up and down depending on the market. Now you can mitigate that risk by buying a rate cap, and that's going to help keep you from having to go above a certain point in your debt service. Now to wrap up, so agency and bridge are going to be the 1-2 punch for multifamily deals. Understanding both of these lending options is going to give you a solid foundation when it comes to financing CRE projects. Make sure you check out my next video on CMBS loans. Now, if you got some value out of this video, please go ahead and like and subscribe, and also comment. Let me know what you want me to talk about next, and share this with other people who may find value in it. And make sure you check out other videos because I'm going to be talking about other lending options and other ways to finance commercial real estate and also complete due diligence.